Not cracking, not correcting, but fracturing, because something has changed underneath the price. Something structural, something irreversible. For decades, silver moved in cycles, up on fear, down on relief. But this time, the old rules are failing. Inventories are not refilling. Supply is not catching up. And the price you see may no longer be the real price. East and West are no longer aligned. Paper and physical are no longer speaking the same language. And the deeper you look, the more uncomfortable the truth becomes. This is not about speculation anymore. It's about control, access, and who gets the metal first. And by the end of this video, you may realize why this market may never go back to how it was before. Welcome to the channel, John A.G. If you value calm analysis over noise, if you believe experience matters more than hype, then take a moment to subscribe. Not in a rush, not emotionally, but thoughtfully, the way someone with years of wisdom would decide. And before we begin, tell us in the comments, where are you watching from today? For decades, silver was seen as a simple asset. Its price went up during inflation and fear, then down again once the panic passed. Traders, investors, and even governments treated silver like a mirror of emotion, rising on tension, falling on relief. But today, that old rhythm has broken. What is happening in the silver market now is not just another cycle. It is something deeper, something structural. He knew it the moment he looked at the data. This time, the rally wasn't just about investors rushing in. This time, the supply wasn't ready to meet them. For 6 straight years, the global silver market has been running a physical deficit. More metal is being consumed than is being mined or recycled. This is no small imbalance. It is a long-term erosion of available silver stock, and it's changing the foundation of the market itself. She noticed the signs too. Vaults that once held thousands of tons of silver are now being drawn down month after month. Western inventories, particularly in London and New York, have thinned. Big buyers are showing up in places like Dubai and Shanghai, paying much higher premiums than what the COMEX spot price shows. They're not asking questions, they just want delivery. Unlike the past 2 major bull runs, in 1980 and 2011, the drivers this time are different. In 1980, the Hunt brothers used financial leverage to try and corner the silver futures market. When COMEX changed the rules, raising margin requirements and moving to liquidation only, the price collapsed. But back then, there was plenty of silver available. Vaults were full. The system bent, but it didn't break. In 2011, silver surged again, this time as a hedge against money printing and global debt after the financial crisis. But even then, industrial demand was far lower. Once panic faded, silver supply was able to meet demand again. Prices settled. But in 2026, the world has changed. And this silver rally is not like the past. It is not built on fear alone. It is built on fundamentals. Electric vehicles, solar panels, and high-speed electronics are using more silver than ever before. The demand is not emotional. It is physical, constant, and in many cases, non-negotiable. When a car factory or solar company needs silver, they can't wait for price dips. They must buy it, whatever the cost. A young entrepreneur in Mumbai recently tried to source silver locally for industrial purposes. His supplier told him the delivery delay was 7 weeks, and the premium was almost 20% over spot. He didn't understand how the spot price could be $73, but the real cost was nearly $90. The explanation was simple. Paper price and physical price were no longer aligned. This is where the fracture begins. They, meaning retail investors, industrial buyers, and sovereign wealth funds, are starting to see silver not as a speculative asset, but as a strategic material. It is no longer just an inflation hedge. It is a critical input, a geopolitical tool, and in many cases, a lifeline for industries that must secure long-term supply. In Washington, a quiet shift took place. The U.S. Geological Survey added silver to its list of strategic elements for 2026. That had never happened before. On the surface, it looked like a technical update. But for those paying attention, it meant something else. The U.S. government had begun to treat silver the way it treats rare earth metals and defense-critical materials, not just as a metal, but as a strategic asset. Meanwhile, in Beijing, something even more significant unfolded. China did not ban silver exports outright, but it reclassified the metal as a strategic commodity. Now, every ton of silver that leaves Chinese borders must go through one of 44 licensed firms, and each shipment requires political, not just commercial approval. In effect, silver has become a weaponized asset, a tool that nations can control, restrict, and use as leverage. Just as the U.S. uses the dollar in sanctions, China may use silver as its reply. And if tensions rise around Taiwan, Venezuela, or beyond, the flow of silver could become a casualty. At the ground level, it means delays, premiums, and frustration. But at the macro level, it means something more alarming. The price discovery system for silver is breaking down. The COMEX futures price, once treated as the global benchmark, is becoming irrelevant in regions where physical delivery is king. He saw it clearly. The futures market is built on promises, but promises don't solar circuits or power factories. Only real silver does that, and the people who need it most are willing to pay whatever it takes to get it. So, as the world watches silver prices flicker on screens, a deeper story is unfolding off-screen. A story of physical scarcity, strategic reclassification, and a growing disconnect between what the market says silver is worth and what people are actually paying. This fracture is not a theory anymore. It is here, and it is widening. The only question now is who sees it, and who still thinks we're in 2011. As silver demand increases and physical availability tightens, the institutions managing the paper markets are responding the only way they know how, with margin hikes. For many, this seems like a routine event, a volatility control tool used by exchanges like COMEX to manage risk. But for those who understand what's happening beneath the surface, these rising margin requirements are not signs of stability, they're signs of stress. He observed the pattern quietly. In late 2025, COMEX raised the initial margin requirement for a standard 5,000-ounce silver futures contract from $20,000 to $25,000. Within weeks, it climbed to $32,500, a 62.5% increase in just one quarter. On the surface, this appeared to be a reaction to rising prices and increased volatility. But beneath that decision was a growing recognition. The futures market was becoming unstable, not because of excessive speculation, but because of shrinking physical backing. She recalled how in past cycles, like 1980 and 2011, similar margin hikes were effective. They flushed out retail speculation, cooled down overheated markets, and restored equilibrium. But back then, the system was full of silver. Inventories were deep, bars were available. When leverage collapsed, supply could absorb the shock. In 2026, that cushion is gone. Today, when COMEX raises margin requirements, it's not just chasing volatility, it's responding to a deeper imbalance, one where futures contracts are multiplying far faster than physical bars can be sourced. As a result, the pressure on both longs and shorts is building. But the difference lies in who can survive that pressure. Leverage is a double-edged sword. It works in both directions, amplifying gains but also magnifying losses. When margins go up, traders must either add more capital or reduce their exposure. For weak hands, this often results in forced liquidation, selling positions not because they want to, but because they have no choice. But in a structurally tight market, this creates a strange outcome. Prices fall temporarily due to liquidation, but the fundamentals do not change. There is no new silver added to the system when a trader is forced to sell. No new mining output is created. No new bars appear in vaults. The underlying shortage remains untouched. This is where the divide between paper logic and physical reality becomes most clear. On the COMEX terminal, silver may drop 4 to 6% after a margin hike. But on the ground, buyers still struggle to find metal. Premiums stay high. Delivery times remain long. Industrial consumers, like electronics firms and solar manufacturers, continue to pay up. The paper price moves. The physical reality does not. And now, even shorts. Those betting against silver are feeling the strain. In the past, shorting silver was low risk. There was plenty of metal. The cost of borrowing was low, and the market was thinly watched. But in 2026, sourcing bar-sized silver to deliver into contracts is no longer guaranteed. The cost to cover a short has risen sharply, not just in terms of capital, but in terms of logistics and availability. A hedge fund manager recently admitted that while his short position looked profitable on screen, he could not find delivery bars at anywhere near the COMEX settlement price. His choices were limited: close the position at a loss or try to settle in cash, an option that more market participants are now forced to consider. But as trust in cash settlement grows thinner, the risk of a delivery crisis becomes more real. Even ETFs, often seen as convenient paper proxies for physical silver, are showing signs of strain. As prices rise, institutional inflows grow. But unlike in the past, authorized participants are finding it harder to source physical bars to back those new ETF shares. In some cases, redemption delays and rising premiums suggest that ETF liquidity may not be as deep as it appears. He explained it to his business clients this way: rising margin requirements in a tight market aren't a sign of strength. They are a warning light. The exchange is trying to cool the surface, but the fire underneath is still burning. She put it differently: the higher the margins go, the fewer people can stay in the game. But silver isn't a game anymore. It's a strategic material. And when you're running a factory or a mint or a national reserve, you don't play games with inputs you can't replace. This divergence between paper pricing mechanisms and real-world scarcity is the second crack in the system. Margin hikes, once a tool of control, are now evidence of fragility. They may slow price movements, but they cannot solve the central issue. There isn't enough silver to go around. In a normal market, rising margins reduce volatility, but in a fractured market like this one, they simply reveal who is overexposed and who has actual metal. That's the new dividing line. Those holding leverage are exposed to liquidation. Those holding physical are exposed to premiums, but not risk of default. As we move deeper into this shift, it becomes clear that the futures market is not suppressing the price of silver. It is struggling to reflect reality. The tools designed for price discovery are now outdated, built for a world where silver was abundant and politically neutral. That world no longer exists. The fracture is widening, and it's about to be accelerated by something even bigger: China's quiet reclassification of silver as a strategic weapon. While Western markets focus on charts, margins, and volatility, the most important developments in the silver market are unfolding far from trading screens. They are happening quietly through policy decisions, export controls, and strategic reclassification. And at the center of this shift stands China. He noticed it first, not in a headline, but in a footnote. China had not announced a silver export ban. There was no dramatic press release, no official declaration. Instead, silver was quietly reclassified as a strategic commodity. On paper, it looked administrative. In practice, it changed everything. From that moment on, silver exports were no longer driven purely by price. They became subject to approval through 44 licensed companies, each operating under state oversight. Every outbound shipment now required permission. Every ton became traceable, and every decision could be delayed, reduced, or denied. Not for economic reasons, but for political ones. This is how modern resource control works. There's no need to shut the door completely. All that is required is a gate. She compared it to rare earth metals a decade earlier. China never banned them outright either. Instead, it restricted flows, adjusted quotas, and shaped global pricing indirectly. Manufacturers abroad felt the impact almost immediately. Costs rose, supply chains tightened, and dependence became visible only when it was already too late. Silver is now entering that same category. China dominates large portions of the global refining process. Even silver mined outside its borders often passes through Chinese facilities before becoming usable in electronics, solar panels, or industrial components. That position gives Beijing influence far beyond its own mining output. When export licensing becomes political, silver stops being a commodity and starts becoming leverage. This shift has not gone unnoticed elsewhere. In the United States, the Geological Survey recently added silver to its list of strategic materials. This was not symbolic. It placed silver in the same category as metals critical to defense, energy, and national security. The message was subtle but clear. Silver is no longer optional. It is essential. The timing is important. The reclassification coincides with rising geopolitical tension, especially following the political transition in Venezuela. With the United States gaining greater influence over Venezuelan resources, global energy and metals markets are entering a new phase of strategic competition. In response, China has strong incentives to protect its own supply chains and to develop counterweights. Silver fits that role perfectly. Unlike oil or gas, silver is deeply embedded in both civilian and military technology. It is used in communication systems, missile guidance, medical equipment, and power infrastructure. Restricting silver does not trigger immediate headlines, but it slowly increases costs, delays production, and weakens industrial capacity over time. He explained it bluntly during a private briefing. Silver is the kind of resource you don't notice until it's missing. And when it's missing, entire systems slow down. This is why China's export controls matter far beyond bullion markets. They are not about investors. They are about industrial resilience. By controlling silver flows, China can indirectly influence manufacturing timelines, cost structures, and technological competitiveness in other countries. At the same time, China is aggressively absorbing physical silver domestically. Large bars, kilobars, and raw slabs are being accumulated. This metal is not being recycled back into global markets. It is being held, stockpiled, and integrated into long-term planning. The effect is subtle but powerful. Western markets still trade silver as if it were abundant. Futures contracts change hands thousands of times per day. But behind the scenes, the pool of deliverable metal is shrinking, and much of it is flowing east. She saw the evidence in pricing. Shanghai premiums are not temporary spikes. They are persistent. Even during Western pullbacks, physical prices in Asia remain elevated. This signals something important. China is setting a floor, not chasing the market. And once a strategic buyer sets a floor, prices rarely return to old norms. There is another layer to this strategy. By avoiding outright bans, China avoids backlash. It also avoids incentivizing immediate substitution or recycling efforts. Instead, it allows dependency to continue, quietly tightening the grip over time. This is how silver becomes a geopolitical instrument. The West still relies on paper pricing mechanisms like COMEX to signal value, but China and other Eastern buyers are focused on access, not quotes. They are willing to pay more because they understand that availability is the real constraint. As this divergence grows, the concept of a single global silver price begins to break down. What exists instead is a two-tier system, one price for promises and another for metal. The futures market still claims authority, but authority without delivery is fragile. He summarized it in one sentence. When a nation treats silver as strategy and another treats it as speculation, the outcome is predictable. This is the third fracture in the silver market, not margin policy, not investor demand, but state-level control of supply. And it sets the stage for the most visible consequence of all, a permanent split between East and West pricing, where the number on the screen no longer reflects the cost of reality. The silver market now exists in two worlds. One is built on screens, spreadsheets, and leveraged trades, a digital construct of contracts, algorithms, and assumptions. The other is grounded in physical delivery, metal in hand, and hard premiums. The distance between these two worlds is no longer theoretical. It is quantifiable and growing. She saw the data on her screen and compared it to the physical offers from her suppliers. The March 2026 COMEX contract closed at $72.85 per ounce on Friday. But in Dubai, one of the world's busiest bullion hubs, the cheapest 1 Oz physical silver coin was quoted near $100, inclusive of normal VAT and fabrication fees. Even removing those charges, the spread was unmistakable. A difference of $20, $25 per ounce is not a premium. It's a statement. The paper price is broken. He reviewed the historical charts. There had always been a small spread between futures and retail prices, mostly due to production, shipping, and dealer markup. But this gap, over 25%, was unprecedented outside of temporary crises. And unlike those past events, this one wasn't fading. It was becoming permanent. What was once a temporary distortion is now a structural fracture. And it reveals a deeper truth. The West is pricing silver based on contracts, while the East is pricing silver based on reality. In the East, especially China, India, and parts of the Middle East, buyers are paying real premiums for real metal. They're not interested in synthetic exposure, ETF allocations, or paper hedges. They are purchasing silver to hold, consume, or store, and their price reflects both current availability and future scarcity. Meanwhile, in the West, many investors are still clinging to the idea that the COMEX spot price is the true global benchmark. But what happens when that price no longer clears the market? What happens when bars don't ship at that price and dealers stop honoring it altogether? The result is a silent but powerful shift. Market participants begin to make decisions based not on COMEX, but on Shanghai, Dubai, or private dealer prices. Price discovery moves offshore. The futures market, once the heart of global silver valuation, starts to lose relevance. This is not a prediction. It is already happening. In Shanghai, silver often trades several dollars above COMEX, and those premiums hold even when the Western paper price dips. This is not retail-driven. It is institutional and industrial demand. Chinese manufacturers, refineries, and strategic stockpilers are paying what they must, not what they wish. And because the flow of silver is increasingly eastward, this dynamic reinforces itself. Metal leaves Western vaults, like those in New York and London, and does not return. Delivery bars are being removed from circulation and absorbed into long-term holdings. As a result, arbitrage becomes impossible. The normal price balancing mechanism is broken. He explained it in economic terms. Arbitrage depends on two things: the spread and the ability to move product. Right now, we have the spread, but not the product. This condition, high Eastern prices and restricted outbound flow, means the gap between East and West will not close anytime soon. And in that environment, the futures market becomes not just disconnected, but dangerous. Here's why. If the price shown on COMEX no longer reflects real availability, it becomes a false signal. Investors, businesses, and institutions may assume silver is cheap, when in fact it is not accessible. This leads to underallocation, mispriced risk, and eventually panic buying once the illusion breaks. We've already seen glimpses of this. In early 2026, multiple U.S. bullion dealers began reporting shortages of 1,000 Oz bars, the standard used for industrial and wholesale settlement. Delivery delays stretched to 5 and to 7 weeks. Premiums on large format silver rose to levels traditionally seen in numismatic markets. This wasn't driven by coin collectors. It was driven by supply chain managers trying to secure metal at scale. She contacted 3 wholesalers across Asia. All confirmed the same story. Demand was outpacing refinery output, and sourcing was getting harder, not easier. Prices were rising quietly, not because of headlines, but because of actual competition for physical ounces. Meanwhile, in financial media, analysts continued pointing to the COMEX price as a sign that silver was stable. This, more than anything, exposed the growing disconnect between narrative and reality. It's not just a pricing issue, it's a strategic issue. If a Western company budgets its raw material costs based on COMEX, but must purchase at Shanghai or Dubai levels, it will face shortfalls. If a retail investor believes they can sell at $80, but cannot find a buyer above $60 net of premium and spread, they'll feel trapped. This creates a trust crisis in the pricing mechanism itself, And once trust in a benchmark breaks, it rarely returns. The silver market is not collapsing, it is reorganizing. And it is doing so around physical access, not paper promises. That's why this fourth fracture, the divergence between East and West, is so critical. It marks the point at which the COMEX system becomes a side market, no longer the center. And in that environment, only one thing matters. Who has the metal, and who only thinks they do? This is not about forecasting price. It's about understanding value in a system that's changing shape. The fracture is now complete. Margins have failed. Delivery is constrained. Policy has shifted. And the map of price discovery has redrawn itself. What comes next is not correction. It is realignment.